every batsman that comes into form has a period of not being in form, which is why the batsman is in form. Because if everybody was always in form, then there would be nobody in form, because everybody would be the same, right? So it's like at some point the downsides have to come for the cycles to work out in your favor.
I'm just wondering, from the transaction costs perspective, I've recently heard Vanguard's acquired podcast on Vanguard, and it's a very beautiful line at the end that they said that Bogle understand not about the compounding of returns, he understood the compounding of costs as well.
In a quantitative strategy, we already know based on the backtest that close to half the picks don't end up making money. So anytime the portfolio picks, let's say 30 or 40 stocks, we know in advance that half of them will end up not making money. It's the other half which will make some money, which ideally will make more money than the money that the others lose, and therefore the strategy makes money overall.
Hello everyone, welcome to Know Your Fund Manager series. Deepak, Anoop, thank you so much for joining us today. The idea of Know Your Fund Manager series is for someone to understand the philosophy of the mutual fund, how they're managing the money. It's not about stock tips, it's not about market predictions, it's all about how the money is managed when someone actually gives them to a mutual fund. And by the end of it, I want the viewers to have a better understanding of what they can expect when they're investing in Capitalmind Mutual Fund, when it can actually outperform, when it can actually underperform, what can they expect is something that I want to discuss in this video. With that context, by the way, I've been reading about Capitalmind Mutual Funds reports, and then, your style of managing money. And one theme that I keep coming back to is the movie Moneyball. For viewers who haven't watched the movie, it's a beautiful movie based on real life events. It's about a baseball team, and the general manager of that particular team, who's Mr. Billy Bean, he's actually picked the team members based on data, not based on what the scouts were telling him to do, not the traditional judgment back then based on how a player is wholesome. It's based on who the player based on individual player strengths and mix and matching them so that the whole team is efficient. So that's the idea I got, when I was actually referring to the quant style of Capitalmind Mutual Fund. Deepak, let's start with you. Do you say, since Capitalmind Mutual Fund follows a quant style of investing, do you say that this style of investing is what Moneyball's approach of investing in markets?
So actually Moneyball, honestly Satya, it came from a book. The book was written by Michael Lewis, I think, and then it did chronicle the real story. Yeah. There were budget constraints on the team, and you will see this now in the IPL as well. Every team has a budget, and then they have to select their team members according to the budget. As baseball in the US evolved, they collect a lot of data on the players themselves, right? So you can find out what a person's hitting average is, and pitching and all those characteristics that define a player. And the ideal team that you want has to have a certain set of characteristics that the team members need to have. Now, if you think about it in cricket, or if you think about it in Formula One or one of these games, you will actually notice that there are different skills required for different types of events, games. So you may be playing on a certain type of surface. You may be playing, a batsman may be playing in the middle order versus the top order. The power plays in the T20. You can actually, now we've collected so much information about so many players that you actually get information about which are the players that do well in power plays, well versus certain teams, well versus certain lengths. In fact, Anoop was mentioning that also, the good length deliveries versus short deliveries and so on. So this data is now more widely available, right? The format of your selecting a team no longer has to be I know this player, I've seen them, and therefore I feel that they're a good player.
Not just based on reputation.
Reputation, personal judgment. You're actually using data to say, well, you know what, this guy has done well during this, in these times. And if I wanted a team that does well during the power play and during this and during that, and you have the characteristics that form that team can be wholesome. And if you look at the individual players, you're like, why did you select that person? But that person fits. It's the puzzle that fits into the team, right? If you look at investing, it's gone through a similar thought process earlier. The information was not as easily available. You needed to talk to management. You needed to talk to individual players to just find out what this company does. But now, not only what the company does is public, but it's also that the data of what they do is public. Retail sales, there's a lot of data that's available electronically. Earnings data is now far more electronically easily available. So you have the ability now to look at data itself and find out the players that make the kind of team, the portfolio. What we call a team of stocks would be a portfolio. Right. That portfolio that would perform interestingly in different time frames, in different types of markets and so on. And that kind of helps you build a portfolio that says, well, these are the characteristics I need in the portfolio that is going to be, I want it to beat the index in the long term. But at the same time, I do want to ensure that there are certain other factors that are met, which is shouldn't fall too much, or it should have a layer of understanding of how much the volatility is in the past, where are my acceptable parameters of performance, and then there is not just us that's talking about this. There's a whole body of research that has gone through, I think 4 decades or more of analysis and testing in different markets, whether it's worldwide. So they call it, one of the ways to invest through factors is through quantitative mechanisms is a factor investing concept, where you say, what's the attribute, like you have in cricket, you may have a strike rate as one of the parameters that you select. Similarly in stocks, there may be attributes that are the momentum in the price, the price to earnings ratio may determine your value characteristic, something that's called quality, which is perhaps linked to your return on equity and so on. These are all factors. And then when you test back and say, if I had bought the companies with the highest quality attributes, and because quality attributes change over periods of time, I have to shift away from people who have lost quality to people who have gained quality every year. And if I were to rebalance in that format, how would I have done in the past? I have the ability to test that. And then therefore, we could say the quantitative mechanism is to say, look at this from the strategy angle, not the company angle. The strategy is what you buy. The individual companies may change. That's fine. I don't have to say, I love this bank, I am not going to sell it ever. We don't have to say that. You have to say, I'll be with this bank as long as it meets their quality parameters. But once something else comes along, I have no problem selling it and moving on to the next one. The quantitative thought process is, kind of embeds that philosophy right in there. In the same way, I think when people understand that there's one approach to investing, but there could be a completely different approach, and both could do well. So I don't want to say that the traditional form of investing doesn't do well, but I think this is an alternative approach that actually does quite well. And
that suits your type of investing as a personality also. Yeah, maybe your strengths. Yeah, got it. Now, Anoop, he mentioned that, within the quant that you've chosen one parameter, which is momentum. For someone who don't understand momentum, it's basically looking at stocks that have been already doing well in the market and assume that the trend will continue. Can you let us understand how this works in your fund, like the momentum strategy?
In a simple way, the core strategy is about picking stocks which have done better than the rest of the universe that we're picking from, and then applying certain other filters which are filtering out certain stocks which have either do not have enough liquidity or show significant I would say circuit movement. So typically tends to be the micro caps which are very low float and stuff. So that automatically filters out that part of the what I would call the junk part of the universe, and then focuses on the liquid universe. Within that, which are the stocks which are showing consistent upward movement. So we're not looking for stocks which, let's say, moved up 15% on one day and then did nothing after that. We're preferring stocks which consistently, let's say, move 0.1% per day over a long period of time, which to us conveys that there is underlying conviction about the fundamentals of that particular company or business. So applying that consistently is what we are looking to do when we say we invest in momentum stocks.
And you are saying that there is research backed for this particular strategy.
Yes, absolutely.
Show that it has actually outperformed other strategies.
So there's many different papers examining various aspects of momentum. We've gone back and done our own research on Indian markets in particular. In fact, we published a paper examining that same style of momentum in whether it works in India or not. This was back in 2020 or so, and then we've built on that to kind of refine that idea over time, because any investment style has its drawbacks. So the thing momentum has, it has a tendency to have very fast crashes when markets correct, when regimes completely change. So how do you then account for that? So basis that, we've tried to build in certain other ways of cushioning that kind of a fall in order to have a slightly better risk adjusted performance over the long term.
Okay, so it's not just momentum alone. Got it. Deepak, I mean, glad that you talked about that book. Going back to Moneyball, if you see the movie, just at least whatever is shown in the movie, it's not just data. Sometimes there's also human judgment in selecting the players. Now, here, with respect to your strategy of managing money, is it completely quant and data driven, or is there some human judgment that you would give with respect to managing it?
So, of course, Anoop is better equipped to talk about the exact specifics, but there is a human judgment element, but there are human judgment elements at various levels, right? Is it an algorithm that we run and say buy everything as it says and all that stuff? No, because there are some things that we haven't fed into the algorithm itself. So the fact that a stock moves on circuits is not easily available, and to a certain extent Anup has to make that judgment and say, okay, well, this is a stock that moves on circuits, and therefore it is not, it has to be filtered out. There will be other issues that are perhaps not even part of the momentum as an algorithm, which nobody will quantify, saying there are corporate governance issues, for instance, in some cases. Those are not something that will pollute the algorithm, because how do you go back and say, for instance, that at some point in time Yes Bank had a corporate governance issue? You didn't know at the time that it had a corporate governance issue. You thought it did, or some people thought it did. And anybody you ask today will say, oh, of course I knew Yes Bank had a corporate governance issue. But then if you go back to 2019, you'll be like, no, Yes Bank is fine. It's part of the Nifty. What's wrong with it? It's not easy to backtest a corporate governance problem, if you may. So, but there is therefore human judgment that happens on what you know right now, and those calculated risks have to be taken, and then you'll have to make sure that you filter what you have those human elements in the loop. And the other one is also on liquidity. Liquidity may have been great in the past, but today there may be no liquidity, right? So there is a aspect that says, well, you know what, it's not going to hold. We are not going to be able to buy this stock at all. So there is that also adds a layer of human this thing. But
Right. Got it. If we compare it with the traditional actively managed mutual fund, as you just mentioned, there are funds that may follow value style. That means, just looking at the stock price, which is lower than the intrinsic value. Some may actually look at growth factors, how the earnings is, and some may, as you said, quality. They give a lot of importance to the corporate governance. But I think in your case, when you say actively managed, it's actively managing the strategy that you're following. Is that right?
That's exactly true. So we're thinking from a portfolio level as opposed to company level. So to give you an example, a discretionary strategy might look at maybe 20 or 30 or 40 companies, and they might need all of them to work out. In a quantitative strategy, we already know based on the backtest that close to half the picks don't end up making money. So anytime the portfolio picks, let's say 30 or 40 stocks, we know in advance that half of them will end up not making money. It's the other half which will make some money, which ideally will make more money than the money that the others lose. And therefore the strategy makes money overall. And that is what is the base rate or the probability of out of X number of stocks picked, how many make money. And we know this based on the backtest. So on an ongoing basis, when we have 30 or 40 or 50 stocks in the portfolio, I know for a fact that half of them are not going to make money. And that is, but I just don't know which half, which is why we're buying the entire basket. We're not relying on one or two stocks to give us our entire return. We're relying on those half, which will therefore cumulatively give us ideally returns that beat the benchmark.
Right. Just a question here, because the turnover of the fund, because the stocks that the fund has today, it could be completely different set of stocks maybe in 6 months time. I'm just wondering from the transaction costs perspective. I've recently heard Vanguard's acquired podcast on Vanguard, and it's a very beautiful line at the end that they said that Bogle understand not about the compounding of returns, he understood the compounding of costs as well. Now, when you actually churn the portfolio very frequently, there will be a compounding of costs as well, right? How is that factored in? And the strategy also consider the costs.
So this is where how you backtest, whether it's how close is it to the real world matters a lot. I mean, you can do a theoretical backtest with saying, I would just pick these 10 or 15 stocks and not worry about, okay, what would be the transaction cost? What would be the brokerage you would pay? What would be the liquidity or the slippage that you would see? Because when you're buying a small cap stock, you don't get to buy the stock at the price that you see it at. It typically goes up the moment that you're trying to make a significant purchase. All of that has an impact on the overall return. So the importance is in reflecting the real world in the backtest itself. So all of these costs, the costs of transacting, that churn, all of that is built into the backtest. So when we are evaluating a backtest result, we are looking at net of everything, does it still have a decent chance of beating the index? And only then it becomes a candidate. If it is only, we know for a fact that if it is only barely beating the index, net of everything, then it's not worth it. You might as well invest in the index. So those costs, like you said, are absolutely important, and therefore it's important that any backtest or any historical analysis takes those into account, which is what we kind of have built in to make sure. In fact, we kind of slightly assume inflated costs just to kind of handicap the backtest a little bit more, so that we can have a more realistic comparison against what's going to happen in the real world. But to your point, costs are absolutely vital, and they are part of how we look at and evaluate strategies.
So interestingly, the NAVs themselves of all mutual funds have all transaction costs built in, including our fees. So to that extent, if my NAV goes up more than the index, I have beaten the index post-transaction cost. So the real world scenario of testing it, that means our actual results, will include the impact of transaction cost by definition. So if I have to beat the index, I have to beat it post-transaction cost. So regardless of the number of transactions we do, we have to beat the index in the long term, right? So we have to account for the fact that transaction costs will play a part.
Right. Now, I'm sure that this is one question viewers would have, and even I have it. What is the extra return, at least based on the back-tested results? What was the extra return that your strategy delivered in the past as per the back-tested results? Maybe and the expectation for future.
Well, I mean, this is one of the most trickiest questions that I have ever come across, because putting a specific number to an expected return is probably not going to work out the way as planned. What we do look at is, if you were to look at 15-20 years of data, you know that the Nifty 500 has done roughly about 12% a year. That's where it has been, inclusive of dividends, etc. So we look at outperforming that by a decent margin, so that net of everything, like we just discussed, we're still coming out ahead, because that's the only reason why you would do an active. So that, I mean, backtest results will always look good. So that is something to keep in mind. and we've seen backtest results in the range of 18-19% versus the 12% of the index. But like I said, right, that is history, and the proof of the pudding is in the eating, in what happens going forward in live data, right? And that's what remains to be seen.
In the long term, I would say any strategy that beats an index even by 2 or 3% is a fairly good strategy. You're talking 20, 30 years. There will be points in the middle when you beat a lot. I mean, the essential idea is this: the range of returns that you can get can be very wide. It will never be concentrated in 1 year. So it's not like saying if the Nifty 500 makes 12%, it doesn't make 12% exactly 12% every year. It makes
hardly be in that 8 to 12%. I mean, I was actually looking at the returns. While the long-term return is about 12%, it's hardly in that 8 to 12% or 8 to maybe 14,
It's never
15%.
close. It's
never
either
close.
beating it
It's
by a
either-
lot or
yeah.
underperforming
So
by a
what's the
lot.
best and worst scenario analysis in your backtesting?
would it help? Because if I told you that the best return, I'm giving an example.
Yeah.
But if I told you the best return was 35%, the worst return was minus 25%, just to give an example, on a yearly basis, you would be like, you know what, I'll get in when this plus 35% is there, but that minus 25, I will get out before that. The answer is no, you have to live with both. That's how you get the average return that is lower or something like that. But more importantly, these ranges are wide. These ranges can be, in fact, we've seen this in factor investing portfolios that we've built in the past as well, that they could be, they could induce people to think that they're getting you 40% returns. The minimum they'll get you is like 15%, right? It doesn't work like that. There are periods of rewards and there are periods of no reward. It's like the monsoon. 2 years of great monsoon, 2 years of bad monsoon. But every farmer knows you have to live with the bad monsoon periods also to, and come out alive, and you will make great during the good monsoon time frames. So this is a period of saying there are ups and downs. You have to live with the downs and they live with the ups. The ranges can be crazy, but it would not be in our benefit to say the maximum you can get is so much or the minimum you can get is so much. It's just that the grind has to be followed. The discipline has to be followed. Every batsman that comes into form has a period of not being in form, which is why the batsman is in form. Because if if everybody was always in form, then there would be nobody in form, because everybody would be the same, right? So it's like at some point the downsides have to come for the cycles to work out in your favor. At best, we can try to minimize the pain during the cycles, but to expect the cycles will not come is also dangerous.
Just on that, you might be aware of the SPIVA reports that come out, right?
Yeah.
Where they've done long-term analysis of active funds and what percentage of them tend to beat the benchmark. And in the US, etc., and other markets, they found that over the long term, like 15, 20 years plus, a very small percentage of active funds end up beating the benchmark, which actually makes a case for why not just invest in the index, right? And in India also, it holds to an extent where, the longer the time frame, you see the smaller the percentage of funds that have beaten the benchmark. So at Capitalmind, we have a recognition of the fact that the index is a pretty formidable opponent, meaning as an active manager, you're looking to beat the index in order to justify what you're charging your investors, but that it is not an easy thing. It is not something that just happens on an ongoing, consistent basis. And anyone, I think, who does not recognize that is probably not understanding the nature of the task or what they've set out to do. So as long as we can do that with a reasonable margin, then we have, potentially done our job. But, can I say for sure that every year we will be able to do that? I don't think so.
Yeah, that brings to my next question, which is, the crux of this video also. Like, you backtested the strategy, and what were the periods during which the strategy that you are following may do really well and the times when it may not do well? At least because, of course, I mean, this may be a difficult question for someone who is not actually doing, whose approach is not data-based, but your approach is completely data-based. And what is the previous examples or scenarios say?
So our strategy is flexi-cap. Truly flexi-cap in this sense, it's looking at that entire universe of investable stocks and then picking out of them. It is not discriminating for, let's say, the top 10 by market cap or the top 50 by market cap, which means it's going everywhere, which means it tends to do well when there is broad strength in the market. How would you define strength? Let's say you could do it in different ways. What percentage of stocks are, let's say, within 15 or 20% of their highs? That would be a metric of how strong is the market doing. So there are certain markets where that number is really low. So examples in the past would be 2018, for example. If you look at that year, the bulk of stocks were far below their highs. The market overall was quite weak, but the index heavyweights were doing pretty well. So the Nifty 50 return is actually positive for the year, while anything other than that is negative for that year. So that would be an example of a phase where a strategy like ours would struggle, because the bulk of stocks are struggling. On the other hand, if you look at a market like 2021, where most stocks were near their highs, so the market overall is showing a lot of strength, which means the strategy has a wide set to pick from, which kind of satisfy those conditions, is where it's going to then do significantly better than the benchmark, because that's when the mid caps, the small caps tend to do well, and in times like those, the strategy will have a decent weightage or allocation to some of those stocks. So that's an example of when it would do well versus not as much.
What were you expecting when you launched this fund last year? This year to be?
I think the minute we launched it, Anup was like, oh man, tariffs come and hit you.
Yeah.
And then this Iran war comes and hits you. And then
Murphy's Law.
Murphy's Law. And now there's fertilizers and something else. So there's bad news. But then news comes all over the time. Okay. And so to be fair, the strategy isn't exactly momentum only, right? So it's core at the momentum, but there's a very interesting set of reasons for this. We used to run a pure momentum strategy in the in our PMS earlier, before we started the mutual fund, and we realized that momentum is a great strategy to have in the long term, but there are times when it doesn't actually give you comfort, because it does fall more on the downside, like you've just said in the past.
You mixed other factors also, because you're coming to common people for mutual fund. Is that the reason? Earlier PMS, because it's like highly sophisticated investors, and now it's mutual funds where common people invest, common investors, small investors also invest. Is that the reason why you are trying to hedge it with other factors?
I wouldn't say it is the category of investor. It is really about personality. I think what I have discovered with interactions with lots of investors over the years is, I think the best strategy for an investor is the one that does not give them sleepless nights. Yeah. The classical definition of momentum only looks at 12-month returns. But then we realize that misses a lot of things. That misses the volatility that a stock goes through. So therefore, when we started doing a pure momentum strategy, we adjusted those returns for volatility. So we were penalizing stocks that move up and down a lot versus stocks that are consistent in how they move. So that enables us, what that did was, it didn't improve returns, it improved the downside behavior of the strategy. So the strategy didn't fall as much in times of correction, because now we are eliminating those stocks which tend to have those very violent moves up or down. So those are certain finer points around how you would go about actually implementing a strategy. And that's where the idea around, okay, when the market regime is not favorable, should the strategy still be investing in the same style of stocks, or should it move into something else? And that's where we then prefer low volatility or quality or value stocks when the market is more choppy or sideways as opposed to uptrending.
One mutual fund that is closely comparable to what strategy that you're following is the Quant mutual fund. Whether you may like to comment or not like to comment, but the Quant mutual fund has seen breakthrough when it started showing the performance, and the AUM followed. So do you also are looking forward to that particular aspect, and do you also imagine a similar track record and the path?
So if you look at it, there are different approaches, right? So if you look at a lot of people who were individual asset managers earlier, who came in, Quant was one of them perhaps, and then Parag Parekh and a few of the others, White Oak, who come in with the asset management background. There are others that come from a banking background. the ICICIs, the HDFCs and so on. There's a different distribution network, there's a different philosophy and different. In the end, all of them will only get AUM if you have performance. There is no, I will come in, I will talk to everybody around me and they will all give me money. It just does not happen. Everybody in India is smart enough to know that unless you show or demonstrate performance, you're not going to, get there. So that's a given. We have to get there. And whatever time period you're looking at, if you're saying that I will not look at you until you have 1 year of performance, fine, we'll get there. We'll get to 1 year of performance and then we'll talk. But is our approach like this mutual fund or like that? I'd say, to a certain extent, every mutual fund has to craft its own path. The path to that is not easy. We have seen a lot of foreign players come into the space and leave because of various reasons. Many of them is that they were perhaps expecting to grow at a certain pace, and that pace didn't happen for whatever reason and all that. But we also know that we have to be in here for the long term. We are not in here to say, oh, I'm going to try this for 5 years and then if it doesn't work, I'll just sell and go away. We're here thinking this is going to be our future, our own future, and it has to be an institution that lasts 50, 60 years beyond. And we have to build it to that extent, right? So if we're thinking like that, that is the only way we can hope to say we will get our AUM because of our performance, our style, our approach, our ability to connect with our investors. I think that is what we bring to the table. I don't have a big name to show you. I came in as, I'm an individual guy working out of a small office in Bangalore. We've built a team. We are relatively, we're in Bangalore where everything else happens to happen in Bombay. We are, relatively not even from finance backgrounds ourselves. Anoop is far more qualified than I am, but I finally got myself an MBA degree in 2022.
Wow,
but yes, and through COVID and for reasons that are more complicated than this, but the idea is not so much that we want to we come from backgrounds that are so this thing that we are guaranteed to succeed, right? So if a big name bank today starts a mutual fund, you almost expect that, oh sure, 4 or 5 years they will get there. But we don't come from that, so we don't have the luxury of saying that we have distribution inbuilt or wealth from our ancestors or something like that. But I think we have to go down and prove it from actually doing things, performing, and then showing people how good we are.
Great. Anoop, coming back to you, again, slightly technical. We recently built this particular infographic with respect to any actively managed mutual fund. I believe that this is one of the comprehensive way to actually talk about performance of a mutual fund and analyzing. So if you see, there is a consistency of beating the benchmark, how consistently it's not just returns anymore, it's how consistently the fund is beating the benchmark over the past few years as well, like 5 years, 7 years. Similarly, I guess, you also said Indian investors are smart investors now. They are not just looking at the returns, they also look at risk-adjusted returns. That means for every unit of return that the fund has given, how much risk that the fund has taken. So we also look at risk-adjusted returns. So let's start with consistency in beating the returns, Anoop. Like your strategy, if we say a couple of rolling periods, say suppose I'll take 3-year return. In the past 5 years, look at a 3-year return every day. Like, what percentage of the times your strategy beats the benchmark? I know there is no track record to actually talk about how the fund has performed, but at least based on the back-tested results.
So firstly, I should credit you for the information that you put in terms of how you're assessing funds, right? In most places, you just see point-to-point returns and then you sort by those, and those are considered to be the best funds. Here, you actually looked at rolling returns, which is how we also evaluate anything that we test out, saying if we're testing out a strategy over 15 or 15 plus years, over what percentage of the times on a 3-year or a 5-year rolling basis does it beat the benchmark? And only if it does that on a reasonable percentage of the time is it a viable strategy. So to your question about 3 and 5 year, right? So On 3-year, we in the backtest roughly about 78 to 80% of the time it has beaten the benchmark. On a 5-year basis, the number is actually upwards of 95%. But realistically, I would just say, okay, think of it as 90% of the time it reaches it has beat the benchmark.
Got it. So if we hold the fund for a longer period of time, the chances of actually beating the benchmark during the time period is higher.
Exactly.
Yeah, consistency also tells how the investor is experiencing holding the fund, right? I mean, if there is like a lot of ups and downs, then the experience is also not that great. Now, I've been thinking in my head, it is like, India, it's time to look at Sharpe and Sortino ratio. I just wanted to, talk about Sharpe and Sortino as much as we can, because it's not just about the returns, it's about the risk-adjusted returns. I understand, I mean, returns is what matters, but I guess from an education perspective also, I think it should be inculcated more in people's mind that, what is the kind of risk that the fund has been taken. So, Anoop, why don't you talk about a couple of ratios there, what it means to investors, and especially with your strategy, how do they look? Maybe we can start with maybe the volatility, which is just up and down.
So volatility is obviously the amount of variation that you see on a daily basis, right? So the more something falls or rises, the higher the volatility, and therefore that gets measured as standard deviation. So again, our objective has been in designing something that shows comparable or low volatility than the benchmark. So if the Nifty 500 is at X, what we have looked to do is to do something that is more closer to 0.9x in terms of daily volatility that you're going to see. Having said that, we also expect better Sharpe ratios than the benchmark. So if you were to think about Nifty 500,
maybe a small line about what Sharpe means for an investor.
So in a nutshell, it is the amount of return you're getting for every unit of volatility that you're experiencing, right? So it's literally the return you're getting divided by the volatility of those returns. So if something falls 10% one day and rises 11% the next day, and you end up at plus 1% or so, versus something that does not fall on one day and the other day it gives you 1%, they have two very different risk profiles, if you will, right? So the second fund in that sense has a much higher Sharpe ratio than the first one, because its volatility is much lower. So that's what we're looking at. That's how we evaluate ourselves versus the benchmark, saying how do we compare versus the Nifty 500 that over different periods of time might give you, let's say, 0.5 Sharpe, depending on how you define it. So then our objective is that we need to be above that on a consistent basis.
Is it Sharpe A or Sharp?
Sharpe is
Sharpe.
the more often used.
I think it's introduced by one of the Nobel Prize winners.
Yes, correct.
Fantastic ratio. It's like, coming to Sortino.
So Sortino is sort of like Sharpe, but it's measuring the extent to which it has downside deviation, right? So you're looking at whenever it falls, how much it falls, and what is the volatility in the days that it falls. So again, you want as high a ratio as possible, where if it is falling, let's say, if the benchmark keeps falling, let's say 0.5% over a period of time on a daily basis, and your strategy falls, let's say 0.25%, it by definition therefore has a significantly better Sortino ratio than the benchmark. And that would be one way of judging a strategy. So it always has to be relative to something that's comparable in that strategy. If you were to compare the Sortino ratio of an active fund versus, let's say, I don't know, a hybrid fund which has a significant amount of debt, it will always be worse, because the portfolio which has debt, which will have significantly higher Sharpe ratio, Sortino ratio, as well as Sharpe ratio, of course.
Because the downside protection is there.
Because the debt portion will not fall as much,
right,
anywhere as much. So it will see much lower downside and therefore volatility. So again, the objective is better Sortino ratio than the benchmark, which is again what we've looked to do when we're designing the flexi-cap strategy.
The key difference between the two is that Sortino does not penalize upside volatility, which means if I do very well on the upside, I get penalized by the Sharpe ratio, saying, oh, he's doing more than the average. That's not a good thing. Also, it's almost like saying so the deviations from the average, the higher they are, your volatility looks higher, and it does reduce your Sharpe to some extent, right? So if we were to say that, listen, no, I don't want the upside deviations to be penalized,
Because I'm happy with the rise
I
in the
want the
market.
upside as much as possible, but on the downside, keep my I want to see how I do in my returns compared to my downside volatility, not my upside volatility. And therefore, you kind of, in that sense, penalize less. I mean, I'm simplifying things too much. I know that mathematically all of these can come with caveats, but I'm just saying that you want to penalize downside volatility, not upside volatility. And it's not the only thing. The best Sharpe ratio is sometimes in a fixed deposit, which has no deviation. Therefore, the denominator is as close to zero as, much closer to zero. So you'll find 15 Sharpes, and something like that. But anything, that's why he said compare it, because you're comparing it with the index. You're not comparing with an FD. So you're
Or the
comparing
peers in the industry.
or peers.
Yeah.
So you also evaluate your funds based on the risk-adjusted ratios, if I'm not wrong, like the performance.
This is a lot of what you have here is part of what we call a tear sheet, basis which we evaluate our backtests. We call it a tear sheet. Every time we run a backtest, there is a sheet with the summary outcomes of the backtest before we even get into the finer details. And a lot of what you have here is part of that, saying, okay, only if it is better on all of this, is it worth even exploring further? If it is not as good, then, reject it and sort of move on to the next idea.
Yeah. The next ratio is the information ratio. Yeah. Why don't you also talk about that?
So the information ratio is sort of a variant of the Sharpe, but it focuses on the excess return versus the benchmark. So you have a fund, it is measured against a benchmark. So there is a difference in the returns on a daily basis of the fund versus the benchmark. So you're essentially calculating that excess return and the volatility of that excess return. So now it's almost like you are comparing it versus its benchmark, or let's say the median of all its peers, if you choose. And a positive information ratio implies that this particular fund is doing better than what the benchmark or the peers are doing on a risk adjusted basis. So it is automatically adjusting for that benchmark and saying, okay, since you're, if it's an active fund, you want a positive information ratio versus the benchmark. And that's what you're really looking for when you're evaluating an active fund.
Yeah, the other two ratios which I want everyone to actually look at before investing in a fund, to at least understand what the style of the fund is, to look at the upside capture ratio and downside capture ratio. It tells a lot about the fund in my understanding, like how the style and what it means is. So in your particular case, there could be funds where the upside is very limited, but the downside is very protected, that in the overall long run it actually could perform better. Similarly, there could be funds where the upside ratio is too good but the downside ratio is too bad, but despite, I think there is a trade-off that they are actually taking. In your case, in this strategy, what would an upside look like and what would a downside look like?
Great question. So upside for us is we want to get as much of the benchmark or the peer set's upside as possible. So as close to 100% as possible, but necessarily not 100%. But we definitely want to fall less than everything else when the index corrects. So downside, we want to have low capture. Our capture that we've seen is roughly in the 75-80% range. And upside, it is more closer to, I would say, 95 to sort of 97% range. So when things are good, it does move up. When things are not as good, it doesn't fall as much. That's sort of our objective over the long term, that we think will give you better risk adjusted return.
It's slightly contradictory to the momentum dominated fund, right? But it's because you're actually involving other styles as well. Maybe that's why the upside is slightly
so we want to be mindful of risk. I mean, that is one of the learnings that we've had, that needs to be part of the strategy itself, that if a strategy that goes up a lot and also comes down a lot tends to make people very uncomfortable. And that's where we said, okay, what is something that we can build in which will try and contain some of that downside, which is where Deepak mentioned over the last 6 years, we had tariffs, we had the US-Iran war, we saw significant corrections. And during those corrections, we held a significant amount of cash. Which is what sort of cushioned a lot of that downside behavior. So when the index fell X, we typically fell, let's say 0.7X and not as much as the index. And that sort of helps cushion the downside. And that's where really I'm talking about when we talk about downside capture.
Got it.
Just to add one thing, over a long period of time, every investor, when we've talked to them, on the upside, they want volatility. When the markets are going up, they want you to outperform the market on the upside. Well, market is giving me 24%, you should give me 30. It's natural, and this is on the downside, people then compare it with the FD return. So if it's minus 4%, or you say it's 2% in 2 years, which is what the Nifty has given as of, where are we, June 2026 or May 2026. The comparison is, in 2 years, my FD would have given me 12% versus, or 6% per year, or 7%. So the natural sentiment is not to understand risk-based volatility, volatility-based return. It is to say that on the upside, I want the volatility. On the downside, I want risk control, right? So since you have this phenomenon, I think we should embed it. We think we should embed it inside the fund's dynamics itself, saying we do want to try and achieve this, that we try to focus on better returns on the upside. We try to control risk on the downside.
There's a reason why Daniel Kahneman says the pain of actually losing money is much, much, much higher than the actually joy of actually having it higher. So I think there is also this max drawdown. I think your point on actually trying to mitigate the downside, fall, like how do you look at max drawdowns? Also, if you could explain what drawdown is and how you look at drawdowns in the fund house.
So drawdown is how much a portfolio has fallen from its peak, right? So any given point in time, it has made a peak and it has fallen 1%, so that means it's in a 1% drawdown. When it falls 10%, 10%, and so on. So during the 2008 financial crisis, the Nifty was down about 60%. So just imagine if you had bought on that day when it made a peak, and then seeing that 100 turn into 40. So that is what max drawdown is. So if you look at history of a fund or of an index, over that long period, what is the highest drawdown that it has seen? And that gives you a sense of what to expect. So essentially, what this means is, over let's say 10 or 15 years, you can expect like a 50-60% drawdown. Over a 5-year period, you can expect a roughly 40% drawdown at some point. 3-year period, I would say about 20%, 25%. On a 1-year basis, anytime, I think 15% has been the average. Over any given year, the index has fallen 50% from its peak in that year, which is quite a bit if you think about it. And therefore, it sort of prepares you for what to expect when you're investing in a certain asset class or a fund category, right? So in flexi caps, that number is again similar to what the Nifty 500 has seen, between 50 and 60% lifetime biggest drawdown that it has experienced. So again, our basis is to think about, okay, how are we doing versus what the comparables are doing? And we don't want to be worse than that. So we are evaluating our backtest to look at saying, okay, does it fall more or less? We need it to fall less than what everything else has fallen. Not necessarily by that much. I mean, again, it's in the context of the asset class. Equities can fall 50-60%. So if during that time we fall 40%, then we reckon, okay, we've done a decent job of managing volatility. So that's how we really think about it.
We can just thank you so much. Finally, just last 2 questions, one for you, Anoop. Deepak understood the philosophy of managing money at Capitalmind Mutual Fund. If I have to ask the philosophy of the fund house, not the schemes, but as a fund house, for the investors, what do you say it is?
So, we come in with this experience in the quantitative part of the universe, but this does not mean this is the only way we will always perform. Our long-term focus is to build wealth for our investors. And there are many reasons why people may prefer a complex or a different strategy. We have a multi-asset fund, for instance, Anoop's managing that as well. So there, the philosophy is that you want commodities in your diversification of your portfolio. You want equities, you want debt, you want commodities as well. Then the commodities that are looking at is gold and silver, but there are more commodities than that. The commodities that you do not currently easily have exposure to could involve copper or aluminium or crude oil or zinc or any of these. So can our universe be expanded to give you that access through the mutual fund vehicle, which does not expose you to what do I do with crude oil tomorrow? Or what do I do with aluminium tomorrow? Is it the right time to buy aluminium or copper or zinc? You may not necessarily be in the position to answer those questions, but you do want someone to make those decisions for you and give you that exposure and give you the peace of mind that it's in a mutual fund vehicle where a minimum crude oil exposure will be 6 lakhs or 10 lakhs, and I have like 40,000 rupees. What am I going to do with this thing? But this vehicle takes care of both the liquidity aspect of things, the minimum investment size and all of that, and gives me exposure to this broader asset class diversification that goes in. It's part of our long-term philosophy is to give you this layers of innovation that gives you the layers of process and operational experience and excellence that makes us help you build longer-term wealth.
So sorry, you're saying it could be more than the quant strategy that you're following, right?
Yes, I mean, it's not, today our strategies are quantitative. We even invest in the multi-asset fund in a quantitative approach way. For at least the equity portion, a different quantitative multi-factor approach, and the commodities using a trend following approach, which is again a quantitative approach. In the debt portion, you don't necessarily only get quantitative. Debt is a lot of qualitative research as well, plus the range of products available to you to invest at a certain size may be restricted to certain types of securities, which where the liquidity is only in a few areas. So you will do that, and you will diversify between sectors because you're required to, and so on. So there is a different layers of approach. Tomorrow, like we talked about, the fundamental based approach is not something that we will say we will never do that. We will do all of these things as long as we have a different approach to doing something, and that different approach helps us help you build longer term wealth.
Anoop, finally, I mean, if an investor is looking at the funds that you know, at Capitalmind Mutual Fund, what are the metrics that you want them to evaluate, and what kind of behavior that they should behavior expectation that they should have when they're investing in?
So, I mean, what we have tried to do is to be very transparent in communicating how is it that we invest, how we think about investing. So, we already spoke about how we think about quantitatively. We're not thinking about individual companies as much. We're thinking about the overall portfolio. The strategy itself is quantitative in nature. At the same time, we don't expect all of the holdings to do well. Some holdings will do well and give the return. The same thing done. So the focus is on the process and not as much about individually finding brilliant stock picks, which is very different from how a lot of other fund houses look at it, right? And that is something that I would expect, or I would like to try and communicate well enough to an investor that's how we are thinking about it. We are thinking in terms of a different process, a strong process, as opposed to being brilliant at finding individual stocks and companies. And that's a very fundamental shift in how a fund invests. So I would want investors to kind of understand, maybe read up more. We write a lot about how we think about investing itself. One of my favorite quotes is that the stock does not know you own it. It's a quote from a book. It's a very underrated book called The Money Game, written by a gentleman called George Goodman. And the focus there is that individual companies come and go. Some of them are excellent companies. They are excellent for a period of time. That does not mean that they will be excellent 10 years down the line. I don't know if you or some of the listeners were old enough to have a phone back in, let's say, 2005 or 2006. Chances are it was either Nokia or BlackBerry. And today you don't see them anywhere. At that time, if you were an investor, you would look at those companies and say, these are going to be the winners of tomorrow, because telecom was just opening up in China, in India. More and more people were starting to get cell phones, and Nokia was the global market leader. And they had excellent phones across the entire price range. So the idea that today they are not even a player would not have even, nobody would have expected that to happen. So that's an excellent example of why companies don't necessarily have to stay great. In fact, business history says that companies stay good for a period of time and then they inevitably decline because competition comes in, better people come in, technology advances. So that kind of is a core part of how we think about investing. Overall portfolios, not individual companies, not tied to holding a particular company and saying, no, this will do well in the next 5, 7, 10 years. For the period that it does well, it will be part of our portfolios. When it does not, it will exit. So we're not emotionally invested in any of our holdings.
That's brilliant. Thank you so much for spending your time and explaining the whole process very patiently. I hope you guys see the heights of, epitome at Capitalmind Mutual Fund. Thank you so much.
Thanks.
Thanks so much.